All right, this is Mike Harn with Anlon Construction coming to you with our first ever Facebook Live event. We have Arthur Aranda, a lender from New Jersey who lends all up and down the East Coast, and we wanted to address kind of construction loans 101, what the difference is between construction loans and your normal permanent loans, and wanted to give you guys some background. We have some wonderful questions, but Arthur, could you give us just a little bit about yourself and what you do before we dig into those questions?
Sure. I'm a loan officer at a bank on the East Coast, TD Bank. We lend from Maine to Florida. I've been with TD Bank about 3 years, a little over 3 years. I've been in the industry about 30 years, quite a long time, since right out of college. It's all I've ever done. In the last 3 years, I've just focused on construction loans. And we have a somewhat of a unique product. It's a one-time closed construction to permanent product. And that's really what I do, mostly that.
It's perfect. We get questions about that all the time, and I didn't think about the fact that we have your audience, right? So I own Anlon Construction. I've been building for about 21 years. We do land development, we do custom homes, and we also do spec homes. But we continue to get questions specifically about how we can fund construction loans. And so we were blessed to get a few questions that came in from different viewers on your end and our end. And the first question that we got is, what is the difference between a construction to permanent loan and a standard conventional loan? And kind of from 30,000 feet, how does a construction loan work?
A construction to permanent loan is like a hybrid product. It rolls out like a interest only, consider it like a line of credit. So you're paying interest only on the money as you use it to pay for the construction. Once the house is built, a certificate of occupancy is issued. The loan then converts over to a permanent mortgage. The advantage of that is that you have one closing for both the construction loan and the permanent mortgage behind it. The rate gets set up front, so you don't have to think about or worry about the rate. The entire process is pretty much thought out and structured so that we know, or the builder and the homeowner both know when they're going to get paid, how much they're going to get paid, and it works on schedule, and it kind of eliminates a lot of the guessing or uncertainty on financing a construction project, which can take about a year.
So one of the questions that we get a lot, and you can take this whichever direction you want, is what happens if I own the lot already, and how does it work if I don't own the lot already? Can I still get a construction to permanent loan? I know it'd be two different programs, but if you could kind of broad brush how each of them could work.
Yeah, so this is where there is some differences between lenders and construction to perm financing. So with the ownership of the property, there is no seasoning. In other words, they could have acquired the property a year ago or a week ago, as long as they're entitled, and maybe they could have inherited it. So we don't factor in what they paid for it. That's what a seasoning typically means. So and the reason why we don't do that is because we're really lending on what they're going to create, what the house is going to be after it's built. So we don't put any value on what they bought it for, as long as they're entitled. And then, of course, they have to clear title. They have to, at the closing, we would pay off any mortgages or liens on the property. That's primarily what we, I think where we stand different from some of the other banks. They do expect you to own the property for at least 6 months, sometimes even longer. And what was the other part of that question?
Well, I think the second thing that would come out of what you just said is we're then creating, you said you're lending on the value created.
Yes.
Like most loans, there's going to be a percentage of value. We hear about 100% loans on permanent financing. We even hear about 103% loans.
Yeah.
That's not what we see typically on construction to permanent. What are you guys generally lending at from an equity position?
We'll only go up to 80% of the after completed value. So, yeah, go ahead.
And that would be generally what's happening is the plans and specifications are being created by the builder and the borrower. There's generally some sort of a pre-construction appraisal that's happening, and then you're coming in and appraising at a full doc appraisal after the certificate of occupancy. Is that correct?
Yeah, that's pretty close to how it works. So we get an appraisal done subject to specs, plans, budget, and a contract with the builder. So the appraiser will come back to the bank and give us a valuation, assuming that the house gets built per specs and plans. So then that appraiser then goes out to the property as the inspector, and we typically do 5 inspections over the 12-month period or whatever it takes. And we then disperse funds based on a percentage of work completed per specs and plans. So typically in a contract, you have milestones and you have certain thresholds that are being accomplished, and the builder needs to get paid. So what we do is we reconcile that with our percentage of funding. It hasn't been a problem, but I always let the borrower know that we're going to pay we're going to pay the builder, or we're going to reimburse the homeowner if they've already paid the builder based on a percentage of work completed. And it all comes down to what the appraised value is after the work is done. So the appraiser always has the last word on these construction loans.
So interesting for us, the process is similar with the lenders that we're using out here. Independent appraisals are happening, but the bank inspections that are happening monthly are generally done by someone in the lending department. So they're looking at percentage of completion exactly the way that you have talked about, hypothetically, meaning there's a line item that had X amount of dollars in it. If that line item is deemed 80% complete, they're willing to fund up to 80%. So kind of subtle differences between different lenders and whether they're using the appraiser as the inspector or whether they're using someone in the lender's office. I don't know that it has an issue, but it's kind of interesting to see how it's done differently.
Yeah.
Using that, one other question that we get a lot, and we get this whether we have a cash buyer or whether or not we have someone who's working with a construction to perm lender like yourself, is about contingency. And whether or not, or how much contingency is expected to be in the bank loan, and how that gets funded.
So you're talking about reserve contingency?
Yeah, I would say that each lender has used the term differently.
Yeah.
Meaning that hypothetically, we're taking the overall construction cost of the house, and we're taking a 5% contingency, which is what we tend to do as a standard. That contingency is used for any sort of a cost overrun. It has to be approved by the buyer. It has to be approved, of course, by the builder, and also approved by the lender, showing documentation of why it went over. So that contingency isn't normally on our end used for upgrades. That contingency is used if something was found on site that wasn't anticipated, or as I'm sure you've seen with lumber being 30% off from where it was last year, something where it was contracted correctly, but there are true costs that came in greater. Do you require or do you recommend having a contingency in someone's budget, or how is that funded?
So you're right. We are talking about the same thing. We just called it a reserve or a contingency, I guess, is the same thing. It's typically it is 5%. So whatever the budget is, if it's a $500,000 budget for everything, the borrower, the homeowner, would have to show they have at least 5% over and above whatever the budget is. Now we can also finance that reserve, that 5%.
Provided so if they want the equity position is where they needed it to be.
Yes, exactly right. Yeah, so we put our closing costs we can put our closing costs in the construction loan, and we can put the reserves in the construction loan. And that's very commonly done, actually, because again, as you draw down on this construction loan and you're building your home, you get to the finish line, the house is built, the certificate of occupancy is issued, and you didn't use up all that money. You didn't use up that contingency, or you brought certain things under budget, and you didn't. You end up with $50,000 more than you thought you needed. Well, that $50,000 effectively goes away because the only part that's converted over to the permanent mortgage is what you use. So I think it's
to use builder speak instead of lender speak. If they had a $500,000 commitment from you for a construction loan, but like you said, we didn't use contingency, we were able to come in under budget, and we only spent $450, their permanent loan is actually $450.
That's right. That's exactly right.
Having the contingency is really creating a safety net, providing that the equity is there to ensure that cash isn't coming out of pocket. That's
exactly right. Yeah, the bank wants to be very careful that this is going to finish up with a house that's built. The borrower's not going to run short of funds. That's part of our qualification process. We'll make sure the borrower's got the financial wherewithal to fulfill this contract to the end. Yeah.
I just wanted to tell you how much I appreciated your time tonight, Arthur. I want to make sure we wrap it up. If we have additional questions come in, we'll make sure that we're able to get back to you. But thank you very much for your time, and hopefully we'll get to do this again soon.
Thanks for the invitation.
I appreciate it. Thank you.
All right. Bye-bye.